Well, the Fed came out about 30 minutes ago holding rates steady. We want to get another more specific angle on this story with Ajay Rajadhyaksha. He's the head of U.S. fixed income and securitization strategy at Barclays Capital, and he's joining us from his firm's trading floor in New York. Ajay, when I say we want to focus in, we want to talk specifically about the mortgage-backed securities that are on the Fed's balance sheet and what it's going to do with them. We talked a little bit about this with our previous guest, but tell us, when do you think that the Fed may start trying to offload those assets?
I think almost definitely not in the year 2010. And the reason for that is because of communication issues, right? The first $1 billion of mortgage-backed securities that the Fed sells, everyone in the market is going to assume there's $1 trillion more where that came from. It's very, very difficult to tell the market, look, guys, we promised to sell 50 billion or 100 billion and not $1 more. The market is just not going to believe that. Spreads will widen, mortgage rates will rise, and the housing market is still very, very tenuous. That is not a situation that the Fed wants to exacerbate. So, you know, if you are talking about when they actually start selling, I would imagine when the economy is well on the way to recovery, when the housing market has stabilized a lot more, we are probably talking at least 4 quarters down the road.
So you think that that may actually come after an interest rate increase, perhaps?
I think that is very, very likely. That is not to say that the Fed will not take other steps to stabilize its balance sheet. Term deposits, for example, reverse repos with other participants like money market funds. But as far as selling of assets and especially mortgage assets go, I think it is very, very unlikely to happen before the Fed actually starts to push rates higher.
Ajay, when you talk about a widening of spreads, by about how much are you thinking?
If the Fed actually comes out and says that we are going to have a selling program starting, say, June or July of this year, I can easily see mortgage rates rising by anywhere between 50 to 100 basis points, which, by the way, is the real reason why we do not think the Fed will do this.
Can you just talk to us a little bit more generally about what's going on in the MBS market right now? I mean, we have seen some improvements in some of the housing numbers. We had that big new home sales number. Does that mean you're seeing improvement in the MBS market as well?
No, you're not seeing improvement in the MBS market in the sense that new private label mortgage deals are being brought to market. That is not happening. There is still a wide gap between pricing and actually being able to bring those deals to market. What you really are seeing, what is a positive, is that in the secondary market, prices of existing mortgage-backed securities keep going up. So that is a positive, but you are still nowhere near levels where you can say, fine, the private label market can end up emerging as a source of, as a significant source of mortgage funding 6, 9, even 12 months from now.
So you think that's going to lag any significant improvement in the housing market itself?
Oh, yes. I think the future of U.S. housing finance, the future of U.S. mortgages is very much front and center with the U.S. government right now, whether it be through Fannie Mae or Freddie Mac or through the Ginnie Mae program.
And Ajay, I would imagine too that we're still seeing these foreclosures. We're still seeing way too many Americans with their homes underwater. Does this give you pause for concern? And given the context what Julie was talking about, when does that turn around?
It doesn't for a long, long time. Essentially what we have done, guys, is we have exchanged the future of U.S. housing for the present. You're absolutely right when you mention foreclosures. We estimate that there are as many as 5 to 6 million potential foreclosures and related houses that could hit the market. What we are doing as a government is we are saying the only way that we will allow them to hit the market, if they do, is very, very slowly. What that does is it prevents home prices from spiraling downwards, which is a good thing. But the flip side of that is that home prices are then unlikely to go up, we believe, for several years. Because every time prices try to go up, there will be distressed supply waiting in the wings to quash them.
All right, Ajay, thank you so much for joining us. We really appreciate it. Ajay Rajadhyaksha of Barclays Capital.